Hey traders, welcome back to this candlestick pattern series, and in this video I'm going to talk about the piercing line strategy. I have to confess I've not heard of it called this before when I looked at it. However, I've traded this candle pattern. It makes a lot of sense logically. The supply demand shift is good. It's a really nice strategy, but I didn't realize it was called a piercing line. So there we go. This is what it's all about. Let's draw it on the board. Let's talk about it, and then let's look at the textbook and see if the textbook kind of confirms with what we think about it. So textbook is saying that you have this kind of downtrend, downtrend, and then you have this candle here, a good strong selling candle. The next day you have this, which is your gap lower. I'm going to color it. I'm going to use the standards kind of definition here, where we've got a close above the open is our green line, and the red candle would be the standard stuff with the closes below the open, obviously depending on what settings you're using on your charting platform. But the point of the piercing line is that you have a good move lower, you then have a strong classical trend day high to low move, opens in the upper kind of third, closing the lower third, giving you that solid red. The next day, this is the key to it. Actually, let's just put some markers on here. 1, 2. This is the key to it. The key to it is the gap, right? This level here, the gap, is the key to the whole pattern, because those are in full control here. Supply is much more than the demand. It's overcoming, it has done for a while, it's coming lower. You get that gap, you get the continuation, everybody thinks it's happy. However, bulls are buying that gap and they're pushing it back up into the body of the prior candle. In other words, it's almost like the sellers have had their last hurrah, their last flush, and you're getting that reversal pattern. You're getting bulls thinking, you know what, there's actually reasonably good value this. I will buy this here. I'm going to look to buy it. And then not only that, but they managed to keep the close above. So it's not just a temporary thing. Sometimes you get a short-term little push up that fills the gap, does some work to the upside, and then pushes lower, which will give you kind of the candle with the red body and a bit of a wick there. This is more a case of, hey, we're buying it and they hold the gain. So let's look at it from a perspective of what it looks like on an intraday chart. So number one, that's our first day. So high to low, good solid move, classical thing. Some work to the highs and lows, but ultimately in opening and closing in the upper third, lower third, pretty 101 trend day. Next day, we gap lower, maybe do some work to the downside, but we kind of come up and close, right into that body of the red candle. So that's the red candle, that's the green candle. This is the important section here. The gap, obviously the bigger gap, the better, because if it's still filled the gap and it's closed in the body, very aggressive, bulls are seriously in charge. But it's that intra kind of weak change in sentiment. Now, I wouldn't be using this probably on a very short-term time frame if I was day trading. Perhaps on an hourly you can get away with anything smaller than that. Personally, I don't think that's the best way of doing it. From a daily chart, from a weekly chart, that looks all good. It's the key to it is this gap. The key is that you've gapped lower, you've undone the gap straight away, you've filled it, and not only have you filled it, you've perceived value. The bulls have perceived value by pushing it back into that body. So where would we see this kind of thing? You know what, let's have a look and see exactly what the textbooks say about this, and let's just see if we agree with it. So they're saying that the piercing line is a bullish 2-day reversal pattern. The first day in a downtrend is a long black day, red day here. The next day opens up a new low. Yes, agree with that. And then closes above the midpoint. Okay, so technically, from a textbook perspective, it has to close above the midpoint. Now, that makes perfect sense to me. And I guess if you're going to frame it like that, then that's cool. So here is where they're saying that you must have the close above the midpoint of the candle, the prior candle. So that's your 50% of the move there, and you've got to close above it. Okay, that makes sense, because yeah, if you're using that as your kind of pivot and saying, well, if people have got to close it above it, then that makes sense. Now, in the real world, I would argue, and again, if you agree with me or disagree, then please leave a comment below about this. I would argue that midpoint's quite arbitrary. It makes sense that if you're going to define it and you have to have some sort of definition, fine. But as active traders, let's look at the chart and be a bit more accurate. I would say if you can find a level of resistance, support come resistance, or whatever it is on the prior day, if it closes above that, then that becomes a bit more interesting. Even if that happens to be in the lower area and you get a close above that, that becomes more interesting to me than the arbitrary value of 50%. But I kind of get why they've chosen that number. But if we're looking at an intraday chart and we kind of had this, level here, and then day two, we gap lower. I'm just squashing it a bit here. Gap lower, we pushed up, and we managed to break through that and close above it. Even that to me is more important, that level of resistance and support and cluster of key level, and breaking through that and closing above it, than the arbitrary 50% level. But that's all good and it makes perfect sense to me. Anyway guys, that is the piercing line candlestick pattern. Obviously flip it round if you're using it on the other direction. Where would you use this? Obviously at the end of a downtrend, looking for a move to the upside. Stops wise, I'm guessing that you would probably want to have your stop below the low here, and your entry is going to be when the kind of piercing line candle is completed. More aggressive of you may want to take it as we start to fill the gap. Obviously you're going to get stopped out more often on that, but your risk is going to be less and you may work out better for you in the long term. But classically speaking, I think that's what the textbook will recommend to do. Let me know your thoughts on that in the comments below. Do you think this is a good pattern, not a good pattern, rubbish pattern, good pattern? If you integrate with something else, how do you like to integrate it? What markets does it work for you if you use it, or do you not use it at all? If you like this video, give it a thumbs up and don't forget to subscribe if you haven't already for more candlestick patterns, technical analysis, charting, strategy, setups, discipline, psychology, all the kind of good stuff to help make us better traders. Good trading out there. Take care, manage the risk. See you at the next one, guys.